Now, when you earn money, government is going to want some of that for themselves in taxes. This is unfortunately also true for investments. There are certain exclusions though, so when you are just starting out, there will be little to no tax burden on your portfolio. But as your returns start to grow, so will the annual tax on your investment growth. It's therefore important for all investors to know which taxes apply, as well as which annual exclusions to reduce your tax to the minimum. Different investors, different taxes. The two main taxes that affect investors are tax on income, this is from interest, dividends, or rent, and capital gains tax on the profit you make from selling an asset.
How much tax you pay depends on a number of factors, including number 1, your own marginal income tax rate. Obviously, the higher your marginal income tax rate, the more tax you will pay.
Number 2, the type of investment. This table sets out which sources of income are tax liable dependent on the asset class. Asset classes and sources of return. Interest income. If you own bonds or cash, you will incur tax on the interest income they pay out. This interest income is subject to income tax and is taxed at your marginal tax rate. All your sources of interest income are added together, and this number is used to determine if you have to pay tax on your interest income or not. SARS sets out the exemption amount for every tax year. For both 2022 and 2023, this exemption is 23,800 Rand for individuals under 65 years old. Therefore, if you earned 23,800 Rand or less in interest for the year, you will not be liable for interest income tax. If you earned more interest income, you will only be taxed on the portion that exceeds 23,800 Rand. For individuals 65 years or older, the threshold is 34,500 Rand.
Dividend income. For equities, excluding listed property companies, you will incur dividend withholding tax, DWT, on the dividend income they pay out to you. DWT of 20% is withheld from your dividends before they are paid out or reinvested.
Property income. The tax regime associated with listed property companies in the form of real estate investment trusts, REITs, is more complicated than other asset classes. REITs are taxed differently to other listed companies. They do not pay corporate income tax, and their investors do not incur DWTs on the distributions they pay out. Instead, investors pay income tax on the distributions they receive from these REITs at their marginal income tax rate. For this reason, higher income earners, those above the 20% income tax bracket, will pay more tax on their REIT shares than on non-listed property shares, since they pay at their marginal income tax rate and not CGT.
What about capital gains tax? CGT is another tax associated with investing. A capital gains event is triggered only when you decide to sell part or all of your investments. The difference between the original price you paid for the asset and the price you sold it at is your capital gain or capital loss if the value has declined. Individuals pay CGT at a rate of 18%. For 2022 and 2023, individual taxpayers enjoy an annual capital gain exclusion of 40,000 Rand.
Retirement annuities. Contributions to retirement funds are tax deductible within certain limits. In 2023, the maximum tax deduction you may make in a tax year is limited to the greater of 27.5% of taxable income or remuneration from your employer, subject to an annual ceiling of 350,000 Rand. By taking advantage of the tax deduction limits, you can save additional money on your annual taxes. Although contributing more to your retirement savings at an earlier age means that your annual take-home pay will decrease, less of your money will be lost to tax. Remember that your retirement contributions are still your money, whereas tax paid is effectively the government's money. Another way of looking at this is that by utilizing the retirement annuities tax benefit, the South African Revenue Service is paying almost 12% of your retirement contributions for the year.